Who gets hit hardest by Trump's tariff plan? The answer may shock you. Trump's new universal tariff proposal is here, and it's about to shake up the investment world. If you think it only hurts China, think again. Stocks, commodities, even crypto are all in the crosshairs, but the real shock? It's probably not who you think. Let's break it down. A universal tariff is essentially a tax on all imported goods. Trump is proposing a minimum 10% tariff on everything coming into the country. This means everything from electronics to agricultural products just got more expensive. And as any investor knows, markets don't like surprises. Tariffs have a ripple effect. Stocks are often the first to react to major economic policy changes. Imagine a factory, a retail store, and a tech company, all potentially affected. Several sectors are particularly vulnerable, including manufacturing, retail, and technology. These industries rely heavily on imported goods and materials. Higher import costs translate to higher consumer prices. This can lead to slower sales and ultimately impacted profits for these companies. Remember past trade wars? We saw similar market reactions. Commodity prices are notoriously volatile, and tariffs can amplify these swings. Think of wheat, oil, and metals, all essential commodities. Tariffs disrupt established supply chains, creating uncertainty. This uncertainty leads to price volatility both up and down. Understanding these movements is key for any investor dealing with commodities. It's about anticipating the shifts. The world of cryptocurrency is always unpredictable, and tariffs add another layer of complexity. Will crypto surge or slump? The answer depends on several factors, including the dollar's reaction and the overall escalation of trade tensions. Crypto could act as a hedge against economic uncertainty. However, remember that crypto itself is inherently volatile. It's a high-risk, high-reward asset. Here's the shocker. Ultimately, the consumer pays the price. It's a chain reaction that starts with tariffs. Businesses don't simply absorb the increased costs, they pass them on to consumers in the form of higher prices. So, while companies might initially feel the pinch, it's the average person who ultimately foots the bill. This can lead to decreased spending and economic slowdown. So, what can beginner investors do to protect themselves? Here are a few actionable steps. First, watch manufacturing, retail, and tech stocks closely. These are the sectors most directly affected by tariffs. Second, avoid overexposure to import-reliant sectors. Diversification is key to mitigating risk. Third, consider hedging your portfolio by diversifying into assets that benefit from a weaker dollar. Gold and international stocks are two possibilities. The smartest move any investor can make is to educate themselves. Stay informed about market trends and policy changes. Adjust your portfolio accordingly based on your risk tolerance and investment goals. Don't panic sell. Now, I want to hear from you. Which asset do you think gets hit hardest? Stocks, commodities, or crypto? Drop your answer in the comments below. If you're serious about growing as an investor and want to stay ahead of the curve, hit that like button, subscribe to the channel, and ring the notification bell. We break down complex topics so you can invest with confidence. Thanks for watching and happy investing.